Hello traders. This is Wave Trading Education Part 5. If you have not watched Part 1 to Part 4, you may do so before watching Part 5. Very, very important. And I also encourage traders in their own time on their smartphone and to watch this video, not only to watch them, but to pay attention carefully to everything that we are discussing here. Very, very important for traders that are willing to learn to use the wave principle like a professional traders. All right, let's continue with this series of video about wave trading education. All right, so I'm going to remove all my lines, and my intention in this part of the video is to highlight some very important points. The Elliott wave cycle is formed of a motive wave and a corrective wave. The motive wave is first wave, second wave, third wave, fourth wave, and a fifth wave. Talking about Pfizer stock, American stock listed, my apologies to traders about this pop-up here. Talking about this stock listed on American stock, you can see that we did roughly go very fast. I didn't go too deeply into it. With the motive wave, it is this one here. What I will do, I will highlight it in green because it's a bullish move. We can see the same thing in a downtrend. So in a downtrend, you see consolidation 1, 2, 3, 4, 5. This is a fractal pattern. You can see this on the hourly chart, on a 30-minute chart, okay, on a 1-minute chart, on a 10-second time frame for my friend of a high-frequency traders. All right, on any time frame. Very often, especially on Sunday or Mondays, when the market just opened, you see that. Looking on your left-hand side, the market was consolidating before, New York opens, before Hong Kong is open, before London is open, and then suddenly, poof, price gap up or breakout. And then you will see 1, 2, 3, 4, 5, all right? So this is a motive wave. And then the pullback, all right? The pullback is a correction of the impulsive move. The motive wave is also an impulsive wave, all right? Because you see, one moved up, but it's divided. The internal wave is 5 wave. The correction, there are different types of correction. Some correction are what we call a complex waves, complex corrections. So to avoid making mistake, one should be aware of the complex corrections. A normal correction is just a pullback like this. This is what is creating a lot of problem for aggressive traders that are buying at 50% and 61.8 because they think that correction is just always straight line like this. It's not always. Some corrections are complex. And I was discussing a running flat correction that can go above the high of the motive wave, bringing the price either near the low of the A corrective wave, or even cancelling completely the motive wave, what we call expanded flat correction. All right. So these are what we call a complex correction. There is another correction, which is also a bit normal for traders, is that the price will not go above the high of the motive wave. So once the motive wave is completed, we use our line. Where is the highest point? As it's coming down like this, we highlight it. There's a key level. Why the market stop there? It's a very important level. That's why it changes direction here. The way we call it, as stochastic.com, we call it a hotspot trading zone. Changing direction here because it's important. We also draw a line to highlight the beginning of the motive wave. We want to know where are these levels. Okay, let's color it in turquoise. If you trade, for instance, E-mini, you will be doing this, for the S&P 500 to know your key levels, like professional traders. All right? Okay, by the way, the charting software that I'm using here, that's what we call TC2000, a great software that traders can use, all right? Traders always send me email and say, which charting software are you using? TC2000 I'm using here, all right? So now, we see now as the price So there's another correction that I want to talk to you about. It's a normal correction. So you can see as the price pull back like this, traders will buy. And then the price start going up. They think that it's going to go above it. But some traders are careful. They know, they are looking here. They know there is a resistance here. So they start taking profit. How they start taking profit? Pay attention. We didn't discuss this one before. It's a classic flat correction where the price will come and will not exceed the high of the multi-wave and change direction, or will display a double top or a lower high. Equal high here or a lower high. It's a classic correction. And then it will come back down in 5 waves. Sometimes you go down, you will not cancel completely multi-wave, but we just stop like it did here at 78%, or even come to cancel it completely. Doesn't matter. But the point I want traders to remember, as the price is coming up like this, changing direction here, at a sweet spot, people are happy, 60% buyers are happy, price going up. Do not forget the resistance here. Sometimes the price will not go above it, as it did for the expanded correction and the running flat correction. It will just stop here and then come back down. As the price going down, do not forget the low of the A corrective wave. Do not assume anything, but be aware of the different high probability setup that may arise. That's what we are discussing here. All right? Why the price may not go above the high of the multi-wave? If the fundamentals are not sound, if, for instance, talking about the farmers, all right, price going, someone is sowing, all right, a corn in the winter. It's crazy, isn't it? All right. So you want to know the right season. So if the fundamentals are not sound, if the company is not doing very well, all right, you see the scenario for Nokia. Nokia came under a lot of competition from Apple stock, and you see it went through a lot of problems. All right. So you want to check the balance sheets, the cash flow, the short-term debts, do your verifications. As if the fundamentals are not solid and people start buying anyhow, you see it start going up, but it's not going to go far, because you remember what we talked about, the fair value, the net asset price, the small median line. Fundamentally speaking, the price is overbought. It's too high, all right? They are not making money. They are not dealing with the competition. But again, the price is going up. You know what? The small money will be busy selling it, but do not sell it anyhow, all right? Check the fundamentals, okay? Check the macroeconomic condition, check the S&P 500, use the trading triangle to make excellent decisions. So in this scenario, the price may not go above the high of the multi-wave, and then because people realize that, in fact, we shouldn't be buying it, or maybe as the price start going up, analysts start coming up and downgrading the stock. Or during the earnings season, the company may come out and start giving a lot of warnings to investors. So investors say, well, we didn't know that. We thought that this stock is going to go up forever. But then the company comes with a warning. Maybe people will buy it again. And then the next warning, and everybody start coming out big time. That's when you see it coming down completely. So talking about the multi-wave is a phase of the Elliott wave cycle, but it's not the whole Elliott wave cycle. The Elliott wave cycle is formed of the multi-wave, and the corrective phase, which can be a complex correction. This is a classic, okay, a flat correction, where a stock is going up, but fail to exceed the high of the multi-wave. One should not assume anything. One should understand that the price will always rectify itself. If a financial instrument is well above its fair value and is not making money, is not dominating its sector, or the sector, in fact, is no more interesting to investors, the financial instrument will pull back. The invest is also true in a downtrend. And when people are selling a stock that is normally bullish, that is reinventing itself, that is about to make a huge profit, the stock will bounce up again. All right? So here in this scenario, the price will come and stop here and then come back down big time. You want to know, you want to understand this thing. if you are trading, or if you are using the wave principle. I invite you now, in the next part of the video that we will call Wave Trading Education Part 6, we will talk about internal waves and also about a cycle, a mini cycle within a bigger cycle. See you in the next video talking about Wave Trading Education Part 5. Until the next time, talking about Wave Education Part 6, because this is Part 5, we will go to Part 6. Until the next time, enjoy yourself and be very happy. We are the TSTWSYS008 traders. This is about Wave Trading Education Part 5.